Every veteran in retirement draws from some combination of three streams: a pension for those who earned one, retirement savings for those who built them, and Social Security for just about everyone. Some of you retired from the military after 20 or more years. Others retired from a civilian career. Some served a shorter tour and built your retirement entirely from the civilian side. The specific sources differ, but the shape is the same. Three streams of income paid by different payers on different schedules, taxed in different ways. Most people treat them as one paycheck. That's the first mistake. The second is assuming they all work the way they did when you started. They don't. The rules have changed, the dollar amounts have changed, the interactions between them have changed. Over the next 10 minutes, we're going to walk through each stream, what it pays you, when it pays you, and how it's taxed. By the end, you'll know exactly what you have. That's the foundation. Everything else in this course builds on it. The first stream is pension income. A pension is a monthly check for life, paid by a former employer. For the military retirees in this room, that comes from the Department of Defense, military retired pay for 20 or more years of service. For civilian retirees, it comes from your former employer's defined benefit plan, if they offered one. The math looks similar on both sides. Military retired pay uses the High 3 system. The average of your highest 36 months of basic pay multiplied by 2.5%, multiplied by your years of service. Civilian pensions use a similar formula: final average salary times a multiplier times years of service. The big differences are outside the formula. And if you don't have a pension at all, that's a third path we'll come back to. Here is what that looks like in practice. A military retiree with 20 years of service and a high 3 of $7,000 receives a gross retired pay of $3,500 per month. That number is adjusted every January for the cost of living matching the Consumer Price Index. Over 20 or 30 years of retirement, that COLA protection is worth more than most people realize. It is the reason your buying power doesn't erode. Civilian pensions are different. The formula produces a similar starting number, but most civilian pensions pay a fixed amount for life. No COLA. 10 years in, inflation has quietly cut your real purchasing power by 20 or 30%. Same dollar amount on the check, fewer groceries in the cart. If you have a civilian pension, find out whether it has any inflation adjustment. Most don't. Whether your pension comes from DFAS or a civilian plan administrator, your statement has a few lines worth knowing. Most people glance at the bottom and file it away. That's a mistake. For military retirees, DFAS sends a retiree account statement anytime your pay changes. 6 lines matter: gross pay, the VA waiver, your SBP premium, federal tax withholding, CRDP or CRSC restoration, and finally net pay. The line that catches most veterans off guard is the VA waiver. If you receive VA disability compensation, your retired pay is reduced dollar for dollar by your VA amount. We cover that offset and the programs that restore it in Module 2. For civilian pensioners, your plan administrator statement has its own 6 lines. Gross benefit, the survivor election reduction if you chose joint and survivor, tax withholding, medical premiums if any, and net deposit. Both share the same lesson. The gross number is not what hits your bank account. Read every line. The second stream is retirement savings. These go by different names depending on who you worked for. For career military, it's the Thrift Savings Plan, the TSP. For private sector workers, a 401k. For teachers, hospitals, and nonprofit employees, a 403b. And almost everyone can also have an IRA on their own. Different names, but they all work the same way. You contributed during your working years, the money grew tax-advantaged, and now in retirement you have an account that stays with you, growing or shrinking based on how it's invested. Some of you have 1 account, some have 5, scattered across old employers. Either way, your decision now is what to do with the balance. Every balance you have, TSP, 401k, 403b, IRA, lives in one of 2 tax buckets. Traditional contributions went in pre-tax, lowering your taxable income during your working years. When you withdraw that money in retirement, it is taxed as ordinary income. Roth contributions went in after tax. Qualified withdrawals, including all the growth, come out completely tax-free. Most career workers have a mix of both, often without realizing it. Knowing how much sits in each bucket changes how you should withdraw it. This is one of the most important numbers in your retirement, and most people have never looked. The most important rule to understand about your savings accounts is the required minimum distribution. Starting at age 73, the IRS requires you to withdraw a minimum amount from every traditional account you own, TSP, 401k, 403b, traditional IRA, whether you need the money or not. The first RMD must be taken by April 1st of the year after you turn 73. Miss it, and the penalty is 25% of the amount you should have withdrawn. That penalty drops to 10% if you correct it within 2 years. But the math still hurts. Roth accounts don't have RMDs during your lifetime. That's one of the underappreciated advantages of Roth. Plan for your RMDs before they show up. Many retirees benefit from drawing traditional balances down earlier in years when their tax bracket is lower, instead of waiting for the IRS to force their hand at 73. The third stream is Social Security. Every quarter you worked under FICA wages, including your military service, counts toward your benefit. The decision that matters most for this stream is when to claim it. Here is the math using a typical veteran with a full retirement age benefit of $2,500 per month. If you claim at 62, the earliest possible age, your benefit is permanently reduced to roughly $1,750 per month. If you wait until your full retirement age of 67, you receive the full $2,500. If you delay until age 70, your benefit grows by 8%. For every year you wait, ending at approximately $3,100 per month. That is a difference of more than $1,300 a month for the rest of your life. Over a 20-year retirement, the difference between claiming at 62 and claiming at 70 can exceed $250,000. Social Security is not just your benefit. A spouse can claim up to 50% of your full retirement age amount, even if they never worked. A surviving spouse can step into your full benefit when you pass. That makes the claiming decision a household decision. The higher earner waiting longer doesn't just protect their own check. It protects the check that will eventually pay their spouse. Run the numbers as a household, not as an individual. Now let's put the three streams together. Pension income, military retired pay or a civilian pension, is taxable at the federal level as ordinary income. Military retired pay is adjusted annually for inflation. Most civilian pensions are not. VA disability compensation, if you receive it, is completely tax-free. Traditional TSP, 401k, and IRA withdrawals are fully taxable. Roth withdrawals are tax-free. Social Security is partially taxable depending on your other income. The order in which you draw from these sources changes your tax bill, sometimes by thousands of dollars per year. The general principle is to draw from taxable sources in low-income years. Preserve tax-free sources for high-income years, and never let an RMD push you into a bracket you didn't plan for. Module 4 covers this in detail. Before our next session, do 3 things. First, pull your most recent pension statement. Military retirees, log in to MyPay at mypay.dfas.mil. Civilian pensioners, log into your plan administrator's portal. That's usually Fidelity, Empower, or your former employer's HR site. Read every line. If you don't have a pension, skip to step 2. Second, log into every retirement savings account you have, TSP at tsp.gov, any 401k or 403b from a former employer, any IRA, and check your current balance, your investment allocation, and your beneficiary designations. Third, log into ssa.gov, create or sign into your account, and review your estimated benefit at 62, 67, and 70. Write those 3 numbers down. Bring everything to Module 2. We will use it. Knowing exactly what you have is not optional. It is the work. In Module 2, we cover VA disability compensation in depth, filing a claim, the rating process, and working with a veteran service officer. For those of you who have both military retired pay and VA disability, we cover the programs that restore the pay your VA amount waives, concurrent retirement and disability pay, and combat-related special compensation. And we cover the scams targeting veterans who receive either Bring your numbers. We'll get to work.